Hey, business owners, we know you know the importance of maximizing every dollar. With the Delta SkyMiles Reserve Business American Express card, you can make your expenses work just as hard as you. From afternoon coffee runs to stocking office supplies and even team dinners, you can earn miles on all your business expenses. Plus, you can earn 125,000 bonus miles for a limited time through October 29th. The Delta SkyMiles Reserve Business Card. If you travel, you know. Minimum spending requirements and terms apply. Offer ends October 29th, 2025.
Reality radio for a really great future. We're talking real money.
Well, after spending some time with ChatGPT, I think I have to work on my robot voice so that I can still have a job, actually.
That's a pretty terrible voice. Robots sound really good these days, don't they? Anyway, we had ChatGPT on last hour, so I just thought I'd mention that. Hey, everybody. Welcome to Talking Real Money. I'm Don McDonald. Good to have you with me here on the radio show that becomes a podcast next week, because I sit here in my studio and I edit it down into a podcast and put it up on all the podcast services. But in the meantime, it's a radio show every Saturday from noon to 2 Pacific time. For those of you listening elsewhere in the country, 3 to 5 Eastern time. And one of the best parts about it is that it is the only time during the week that Tom and I are able to spend a couple of hours interacting live with you, where you call us and we have a conversation. And you do that by calling our phone number. Old-fashioned idea, I know, but it works. That number is 855, which means it's toll-free. For some of you young people, you go, what the heck is toll-free? We'll ask your folks to explain it to you. Toll-free, 855-935-TALK, 855-935-8255. Yeah, I know, we live in an age where you can call anybody anywhere toll-free. Remember? Those of us who are older, remember when you thought it was a special thing to make a call from Seattle to New York City, and it was something you maybe did once a year because it was so expensive? Yeah, those days are gone. Anyway, thanks for being a part of the show. Tom is off this week. He's taking care of some family stuff. And so you got me alone, which works for me and hopefully works for you. And you'll call me and we'll talk and we'll spend some time together. 855-935-8255. As you know, Tom and I every week look forward to seeing what the latest information is being shared by Jason Zweig at the Wall Street Journal. We love Jason's stuff. Well, this week's article is about insanity in the guise of investing. It is absolute nuts. Out of 672 new exchange-traded funds launched in the U.S. this year, almost 30% of them are tied to a single stock. So in other words, you're buying a diversified ETF to own a single stock. What about that makes any sense? And 25% of those are leveraged so that you get more than the movement of the stock, which is wonderful if the stock is going up. It is disastrous if they're going down. So the risks are just out of this world. And yet, lots and lots of people are playing these kinds of funds. And literally, it is playing. It's not investing. This is incredibly dangerous. As a matter of fact, it is no different. I'm telling you, it's absolutely no different. I don't care what you believe. This is no different than going to a casino and gambling. None whatsoever. There's no difference. And even crazier now are the trades that are now happening in, get this, they're called 0-day options, where basically you can bet on the movement of the S&P 500 through an options contract minute to minute, second to second. that is absolutely no longer investing. That is absolutely gambling that somehow has managed to become legal in every one of the 50 states. I mean, sports betting, it's like that, except you can bet on the games minute to minute too, can't you, with your little parlay things? But in some states, it's still illegal to do that. In those states, it's totally legal for you to trade 0-day options. And don't even get me started on all the people just trading individual stocks, buying and selling things. I mean, we talked about this before, but this is also in the article. Ro Khanna, who is a California representative, reported 2,800 trades so far this year. 2,800 trades so far this year. That is absolutely, I mean, think about it. There's the next closest trader is a guy who's done over 600 trades. That's averaging 4 trades every day that the market was open. This is no longer, we have left the realm of investing, and we have truly slipped deep into this craziness called gambling. And if you don't believe you're a gambler when you're playing this stuff, then you are just, you're delusional. You're just fooling yourself, and you're doing yourself a massive disservice. And your family, you need to stop this. If you're going to gamble, call it what it is. Go to Vegas. Go to Muckleshoot, or whatever the other ones are around the area in Seattle, or wherever you live. But don't pretend this stuff's investing, because it's not. 855-935-TALK is our phone number. Let's talk about your money, shall we, for the next, 45 minutes.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com, or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Well, you got half the crew here. You got Don. Tom's taking the weekend off. 855-935-TALK. That's the number you use on your telephonic device to come over here and talk with me about money things that are important to you. So why don't you do it? Grab a phone, give me a call. 855-935-TALK, 855-935-8255. And let's go to the Research Triangle, Raleigh, North Carolina. Mike, welcome to Talking Real Money.
Hey, Don.
Hey, Mike.
Well today?
Yeah, thanks.
Good to hear. Question for you. So I'll try and lay out my financial picture. I'm 54. I make about $400,000 a year. I've got about $7.5 million in our investment portfolio. About half of that is in retirement accounts. So my issue, I would say, the next 15 years is really trying to move money out of my retirement assets into Roth or other sorts of things. But I'll deal with that. I make too much money, I think, to be able to start transitioning that. But my kids, we loaded up. My kids, 20, 19, and 16, each one of them has a Roth that we funded about $150,000 to $200,000 in each. So I love the tax law that came out in 2020 that allows us to convert some of that 529 money into a Roth for them. Mm-hmm. And they were doing that a little bit before. We expect them to work, those kind of things. My question for you is, a 20, 19, and 16-year-old, they've each got not quite 100,000 in a Roth right now. What is the most? I'm anticipating not to touch the next 40 years.
Yeah.
Did you have a question?
Yeah.
All right.
How do they get that much money in a Roth?
Well, we had our own business. We were doing a few other things, and they were cutting grass when they were kids, washing cars.
But I mean, is that in total among all of them, or per kid?
That's each of them.
Well, because you got the max contributions. Wow, they've been okay. That's a lot. That's really good. Wow.
The last 7 what the market's done, so it's been good.
Wow, and then given the fact that you can take $35,000 of that 529 money and feed that down the road into all of their Roths, and or they can do it when they're older. Oh my goodness, your kids are set. Just stop. Just let them go. They're done. They're retired. No, I'm kidding. But wow.
Well, Don, they don't know they have that money in there, by the way.
Oh, yeah, good. Don't tell them.
So, no. So what is, if the idea would be to not touch that for the next 40 years until they were to retire, do you have recommendations? And I always love listening to y'all talk about ETFs and funds and those things. If it were your kids, would you what would be the most aggressive fund you'd put that in? And would you do anything in a bond, or would it be 100% equity?
It would be 100% equity. I would do no bonds. Bonds are there when you have somebody who might worry and panic, who might do something stupid when the market goes down. If you know that the market will go down and there is nothing you're going to do when it does, you're not going to change the portfolio, then you can be all equity, hog wild, crazy, aggressive. You could be AVUV aggressive if you wanted to be. And that's aggressive. That's small cap value. AVUV, which is the Avantis Small Cap Value Fund. I'd probably lean more towards something like the AVGE, which is the Avantis Total Market, but it still has a small value tilt, and it buys them basically almost all the stocks in the world with a few exceptions. The equivalent of that at Dimensional is DFAW. They're very, very similar funds. They give you U.S. and international. They have a greater amount of small cap and value stocks than would a total market index like the Vanguard Total Market, which makes them more aggressive inherently. But historically, it would have made them long-term, 40 years, it would have made them more lucrative.
Okay. So AVUV, AVGE, and the DFAW.
Yeah.
And that was going to be my next question. That, it sounds like those, do you have a weighting that you like for that for international
I personally, I would overweight international a little more than they do. I think AVGE is like 6, is it? AVGE is like 70-30. U.S. to international, and I'm a big fan of being closer 60-40 or even 50-50, but that's good enough. Again, we're quibbling over teeny little differences that over 40 years might make a little more. Now, if you, again, as I said, if you want to go hog wild crazy, this is money that they're not going to touch. Even if the market goes down 75%, you're not going to do anything. Then an AVUV is going to focus on small and value even more. And again, over a 100-year time frame, the numbers show the difference between the returns on the big company stocks and the small and the value is massive. I mean, massive. It's like the difference between earning thousands of dollars and hundreds of thousands of dollars over 40 years.
Okay.
But it's crazy aggressive. Not crazy like buying Tesla.
Well, at this point in my life, until we get further into retirement, I like a pullback. It gives a chance to put more in. So we've been very disciplined. And look, you and Tom and Don. Excuse me.
I'm Don. Yeah.
Sorry, Don.
That's okay.
Yes. But listening to y'all over the years has helped position our mindset that way. So thank you. One day I'll have my 3 kids. and say thanks.
This is thanks enough. And man, this just shows that if you do this and you just keep saving, wow, there's a lot of money that can be made.
Tom and Don are talking real money.
The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. From improving emergency response times to protecting against cyber attacks, local, state, and federal governments are innovating with Google AI. This is a new era of American innovation. Find out more at g.co/American innovation.
For your real life and real future, Tom and Don are talking real money.
And money is really important, which is why we think it's something that deserves to be talked about, both on our show and our podcast, both of which go by the same name, Talking Real Money. I'm Don. Tom's away for the weekend. You are the people I want to talk to. Call me. 855-935-TALK, 855-935-8255. I had no idea that toll-free numbers worked from outside of the U.S., but apparently they do, because now we're going to Israel. And Dan, welcome to Talking Real Money.
Hi, Don. Pleasure to talk to you. I've been listening for a few months. Unfortunately, not earlier. I would have learned a lot more before. You talk about being a fiduciary. So I just wanted to ask, are there certifications for that? How do you know if you ask somebody, a broker or an advisor, if they're a fiduciary, if they actually are?
Great question. One of my favorite questions, and the answer is you don't. They can lie. There's no law against lying and saying you're a fiduciary, and there is no certification, although there's a made-up one, a certified fiduciary, which is just something you can pay a couple of bucks and get. I've run into all kinds of advisors who are not 100% fiduciaries, but who have this designation, this fake designation. Well, fake. It's real, but it's not legit. It doesn't mean anything. It doesn't mean you're always acting as a fiduciary. There is nothing that you can do short of your homework. I wish there was. I hate that there isn't. So what you need to do, Dan, is anytime you talk to an advisor, you want to go to, first you can go very simply to broker check, which is the FINRA website, and type in the name of that broker or that company, that advisor or the firm. If they show up on broker check and you don't have to click a button to go to the SEC site, then they are not always a fiduciary. If their name shows up there and it says they're registered with FINRA, then they are absolutely not always required to act in your best interests. Alternatively, you can go to the SEC site, which is advisorinfo.sec.gov, and you can pull up the firm's ADV Part 2. It is not fun to read most of them because they're made by lawyers, particularly the big firms. The shorter the ADV, the more likely it is you're dealing with a fiduciary, by the way. The longer the form is, the less likely they're always a fiduciary. What you want to do inside that is, on your computer, search for conflicts of interest. And if it says in there, we sell commission products, we can sell insurance products, we can sell securities, whatever, then again, you're not talking about a 100% all-the-time fiduciary.
Mm-hmm. Well, further to that is I inherited some money last year, and the advisors, which I also inherited from my parents, kind of, put the money into stocks. Mm-hmm. And I asked them, why aren't you going to ETFs? So they said, well, that level of money, we don't do that.
What?
So I'm thinking now of looking for another advisor. Yes.
Dan, that's exactly the polar opposite. The only way you should ever be in stocks is if you're ridiculously wealthy and have a gigantic portfolio, and even then we don't suggest it. ETFs were made for smaller portfolios. That is just the most spurious argument I think I've ever heard. It sounds like you're with one of the big firms, like a Merrill Lynch or a Morgan Stanley or somebody like that.
No. It's a boutique.
It's a boutique?
Advisor, but it's a good amount of money. It's just that I prefer to go with ETFs, but so now I have to wait. If I don't want capital gains, I'm going to have to wait until a year.
Yeah, but you know what you can do, Dan? You can still find yourself a truly good fiduciary advisor who is going to build you a portfolio, not just buy you some stocks, and put those stocks with that advisor or in their custodial account and have them create a plan to sell them over time, and reduce your taxable events over that period of time to reduce your capital gains exposure. And that's what a good advisor should do. So I would start to put my feelers out looking for, again, do your homework. Read their ADVs. I know it's no fun, but it's the only way you're going to make sure that you find one. Thanks so much for the call. I really appreciate you. Take care.
Tom and Don are talking real money.
This episode is brought to you by Amazon Business. We could all use more time. Amazon Business offers smart business buying solutions, so you can spend more time growing your business and less time doing the admin. I can see why they call it smart. Learn more at amazonbusiness.com.
Reality radio for a really great future. We're talking real money.
And just like that, for the first time in an hour and a half, we have open lines for you. So this is a good time to call if you were thinking about it. 855-935-TALK, 855-935-8255. But never fear, because we always have a lot of questions. And since I don't have Tom here, I've asked. Hold on, let me make sure I have the voice on. Okay, since we don't have Tom here, I have asked Kath to read the next question from TalkingRealMoney.com. It comes to us from Matt in Hyde Park, Utah.
Hey, gents. Your show is awesome. Love to hear your thoughts on a 50% VT, 50% AVGV portfolio.
So 50% VT, the Vanguard Total World Stock Index, and 50% in the Avantis Large Cap Value Index. It sounds like you're going to be way too overweighted in large cap. So I would not have AVGV as the other part of the portfolio. I would probably have AVUV. But I might not make it 50-50 unless if you're comfortable with the higher degree of volatility that's going to come from AVUV, which is the Avantis Small Cap Value ETF. If you're very comfortable with volatility, then yeah, both is fine. But I would not have large cap and large cap. I wouldn't have AVGE, which overweights large. Well, it overweights small in value, but it's still going to have a lot of large. I don't think you need that much large. I wouldn't have AVGV. I'd have AVUV instead. Other than that, really, it's just a quibble. And thanks for the question. Again, if you want to send questions in, you can go to TalkingRealMoney.com, click the contact form, and type them. Or you can speak them. I like it when you speak them, okay? And now, let's go back to the phones. In Seattle, Laura, welcome to Talking Real Money.
Thank you. How are you?
I'm doing well. How are you, Laura?
Fantastic.
Awesome.
So, a bit of a funky question.
I like funky.
I do too. So I have a little bit over $1 million with my JP Morgan financial advisor, and I have about 120 also with JP Morgan in the self-directed plan that I think around with myself and play money, I call it. And with everything that came out, and I knew what JP Morgan, Jamie Dimon and the bad boss guy did with Epstein. But now delving into it with everything that came out with the article, I'm not happy with their ethics and morals. I sent a letter to my guy and So they're reaching out and talking to me because I kind of want to move my money because of their ethics and morals. But I don't know how many other institutions are involved with the lack of morals and lack of ethics. So that's one question. Secondary, at over $1 million, I'm just shy of a 1% fee with having a money manager.
That's not true, by the way. That's not true. Our firm, Appella, we charge a 1% up to $1 million, and then it goes down after $1 million to lower amounts.
Okay.
That's only with the big houses. That's only with the Morgan Stanleys, the JPs, the Chases, the Merrills, the Ameriprises, the whoever it might be. These are let's let the ethics go just for a moment, because determining somebody's morality is tough. The person you're dealing with there may be a very moral person, but that's not the point. The point is you're getting conflicted advice from them. They are not.
Such as?
They're not always required to act as a fiduciary. They may have sold you products that had commissions or high fees or were actively managed. I don't know because I can't see your portfolio. But that would be my guess from my experience and literally decades of experience with these firms. I used to work for one of these firms. Not this one, but the one that now became Morgan Stanley. It was Dean Witter before. Can you give me the name of any investment in your portfolio? Do you remember any of them?
Oh, sure. I've got Alterium. I've got, I don't know, Costco. I got a bunch of different, those kinds of things. I don't have it. I'm driving.
Okay, you have stocks in your portfolio. Do you have any mutual funds or annuities that they put you in?
I do know I have annuities. I'm driving. I don't have it in front
No,
of me.
I don't want you to have it in front of you. That would be so dangerous. Yeah. But if you have annuities in here, then I can pretty much, I can know with a high degree of confidence that this is a commissioned salesperson too. In addition to the fee, they're also generating commissions on your account because annuities are commissioned products.
Oh, absolutely.
Well, but that's wrong.
And it's interesting because no, I agree. And that's I've been wanting to call for a very long time, and I just apparently don't have the courage or the guts, which is stupid because I'm a strong person.
Laura, you're doing it right now. You did great.
Me over the edge. No, I know, but this whole coinky-dink with the Epstein thing really shook me.
I can tell you that in the Seattle area, I know personally of a half dozen highly reputable firms that I am pretty close to 100% confident never had any affiliation with Epstein because they're local firms, and also all of whom act as a 100% all-the-time fiduciary. And you can find a list of those if you go to talkingrealmoney.com/help. Just look for the advisors that we think are probably good for you. We're like Santa Claus in Miracle on 34th Street. We'll send you to Gimbals. We just want you to get better help than you're getting now.
Tom and Don are talking real money.
Raise the rudders! Raise the sails! Raise the sails!
Captain, an unidentified ship is approaching. Over.
Roger. Wait, is that an enterprise sales solution?
Reach sales professionals, not professional sailors. With LinkedIn ads, you can target the right people by industry, job title, and more. Start converting your B2B audience today. Spend $250 on your first campaign and get a free $250 credit for the next one. Get started today at linkedin.com/campaign. Terms and conditions apply.
Your guides to a really great financial future. Tom and Don are talking real money.
Our phone number. Here it is again. You ready? I know you probably, because if you're driving, you're not going to write it down. You have to memorize this. 855-935-TALK. 855-935-8255. So, call. Got time? And hopefully I've got some answers for you. Let's go back to Seattle again. And Jim, you're up. Welcome to the program.
Hello, Don. Thank you. Here's my question. how long would you wait before considering to invest in a new ETF?
I'm not sure. I need some background because if I pick the right ETF for the right reasons, I would not switch unless my risk tolerance or needs changed. So it wouldn't be a time thing. Are you looking at it from a return standpoint and thinking this one is not performing up to snuff?
Well, I'm thinking there's a new ETF out. It's ticker TOT, and it's basically
tater tots. What?
They're investing in a collection of. I'm sorry,
tater tots or something. They're buying potato. No, it's the
TOT.
Okay, yeah, Lion Share U.S. Total Return ETF. Never heard of TOT.
Yeah. It's brand new, and what it's kind of claim to fame at this point is it's got some way to eliminate the taxable dividends that occur through an ETF.
Mm-hmm.
And I was just thinking it'd be a good way to save taxes.
Mm-hmm. Wow. I am gonna let's see. What do they hold? Oh, it's a fund of funds. Oh, isn't that interesting? So they have the Vanguard Total Stock Market ETF, which I assume is VT. They have some smaller cap. They have the QQQ, the iShares Total, the S&P. It looks to me like they're heavily weighted toward large cap growth, and it looks like they are going short to do something, and I'm really, truly not sure what that something is that they're doing. But what do you have the money in now that you might be leaving to go into this?
The Vanguard Total World Stock.
VT? So you have the VT, you have the ETF. I just want to make sure it's the Vanguard Total World ETF and not the fund. Okay.
ETF.
Yeah, let me just take a peek because I don't think that VT distributes much in the way of dividends.
No, it's actually pretty small.
Yeah, it's so small as to be
being nitpicky.
Holy cow, it's small. Yeah, let's see. They have the price per share is in the 120s, and they're distributing. They've had a 40 to 90 cent distribution. It's not worth the bother. I wouldn't mess with it. As a matter of fact, whatever little difference it might make is probably going to be offset by the slightly higher expense ratio.
Okay. Well, great. Thank you very much.
In terms of the portfolio, I don't know what the trick is. If the trick is legit, and I'll do some more research and see if I can find out, because you kind of caught me off guard with this one, but that's good. I like being caught off guard. I will do some research. It may be that they have a magic trick. I don't know what that magic trick might be. But if I already had VT, I don't see how it's going to make that much difference.
Okay, great. I appreciate it. Thank you. Thank you very much.
The income distribution, you get to keep most of that. You only give a little smidge of that. What tax bracket are you in? Oh, he's gone. Okay, he's gone. If you're in a small tax bracket, we're talking so many pennies. It's just pennies. I don't want to get something new anyway, unless the something new is based on something that is old, that I know well. And it may be that this fund is based on something old that I do know, but I don't know what that would be. I really don't. 855-935-TALK is our phone number, and we've got a line open for you right now. I'm wondering if I should do this question right now. How much time do we have?
Minute 10.
Oh, okay, let's do it. Let me just get Kath to ask this next question. Hey, Kath, can you ask me that next question?
Of course. Here's that next question. My mother and I have similar investments in our respective brokerage accounts. I need to liquidate some of the index fund holdings I have in order to free up cash, and I'll go on and read the rest just like that whenever you give me the cue.
All right, that was the cue. It was worth a try. Thanks. I'll go read it myself. I don't even remember where we left off. Yeah, okay. He and his mother have similar investments. She has gains in her account, but she has lower gains than he has. And basically, he wants to know if they can swap gains. That he can gift her his bigger gains in the exact same fund, VTI, and she can gift him her smaller gains in the same fund, VTI, so that he pays less because he needs to get some money out. And no, you can't do that. The IRS can see right through that trick, and they will not allow you to swap shares with somebody else to reduce your taxes. They're going to charge you based on the gain. Now, no, because you need the money. That I was going to throw in some other complications, but you're going to be taking money out. So if you're going to be taking money out, you got to pay taxes on the gains. Thanks so much for the question. We'll be back in a minute. 855-935-TALK is the number to call every Saturday.
Tom and Don are talking real money.
If you thought goldenly breaded McDonald's chicken couldn't get more golden, think Golder. Because new sweet and smoky special edition gold sauce is here. Made for your chicken favorites. At participating McDonald's for a limited time.
For your real life and real future, Tom and Don are talking real money.
Hey, this is new technology we're using here, so it's going to be glitchy. But I've got Kath back, and she's got another question that she's going to read for me here in the last segment of the show. Go ahead, Kath, read that question.
Absolutely. Here we go. In my long-term retirement, I use a 3-bucket system. My equity portion is 75% global equity and 5% small cap value. For the small cap, I use Dimensional's UX Small Cap Value ETF, DFAW. For the global equity, I actually use 3 funds with a little different factoring rather than focus on any one. You talk about VT and DFAW, which each have 25% of that 75%. I also have 25% of the portfolio in iShares Global Equity Factor ETF. Do you have a perspective on the use of GLOF versus the AVGE you talk about? I've been listening to you for a few months and suspect that the second part of your answer will be that I'm making things more complicated than needed. I will say that between these 3, I only rebalance with new money, while between the global equity, small cap value, and fixed income, I rebalance quarterly.
All right, good, interesting question. And yes, you're overthinking it, but that's okay. We do that as human beings. We like to think, and we think a lot about a lot of stuff. The iShares Global Equity Factor Fund is a very similar fund. It's a really good fund, and it's fine, absolutely fine. It is a good substitute. It's very likely to give you similar returns because I don't know anything about the future. So I do think that you might be trying to make it more complicated, but no, there's nothing wrong with the iShares Global Equity Factor Fund. It's just we don't want to add that in because we don't want to confuse people even more, because there are a lot of factor funds hitting the market, and that is a good thing because we are proponents of factor investing. Quarterly rebalancing, you are an overachiever. Again, if it works for you, that's great. Would I do that? Heck no. It's hard enough for me to rebalance annually, or if things get way out of whack. But if it works for you, great. Dimensional Small Cap Value ETF is a great fund. I think you've got good stuff. Is it different than what we suggest? Yeah, but that's only because we're trying to make suggestions that are easy to follow. That's the main reason. We don't want to confuse the listeners with this variety of choices. We used to, years ago, suggest a 10-fund portfolio like Paul Merriman's, and we found that people just couldn't do it. It was way too much to follow, way too much work, way too confusing. And the differences between keeping it simple and being complex are not enough to overcome the disadvantages in many cases. So thank you so much for the question. These were all sent in at talkingrealmoney.com because on Saturdays, that's the only time we take calls at 855-935-TALK. So if you want to ask questions, go to talkingrealmoney.com, click on the Contact Us button, and instead of typing them, please speak some of them. I use those, and then you'll know when your question is being answered too, because those always get answered on the Friday Q&A podcast. So you can listen to the podcast on Fridays and know within a few weeks of you asking the question, it's going to get answered by me. That's my show. I do that one by myself. And thank you all for being a part of this one. And Tom should be back next week. So I hope you'll be here again next week and then the week after and, so on. And if you need some real serious help, we are willing and able to provide you with some advice from an advisor. Go to talkingrealmoney.com and click on Meet an Advisor.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.